In this video, we discuss why your target date retirement fund crashed in 2022, even though it had the right balance. Coming up next on Holy Schmidt.
Holy Schmidt!
If you talk to a lot of retirees, one of the common themes that they have is that they don't understand why their target-based retirement fund, the one that is supposed to rebalance and de-risk as they get closer to or enter retirement, actually had such a horrible year. And for those of you who don't know how target date funds work, as you get closer and closer to retirement, the fund sells risky equity investments and replaces those with less risky debt investments, bonds, money market funds, and that sort of thing. Along the way, the retiree gives up some return, but in return for giving up the return, you, the retiree, have more predictability and more stability in your investment. And the expectation is that when the big one hits, you're relatively safe compared to everybody else. I've had a few people comment when I talk about target date funds that no investments are guaranteed. That's absolutely true. The expectation, though, is that if you're going to give up the return and the big one does happen, then you are somewhat protected or insulated. And frankly, this was a good test of the big one happening, and the target funds didn't do very well. Otherwise, people would just invest in an index fund and that would be it. So for those of you who own a target date fund, you want to know why your investment went down so much. Number one, because it's your investment, but number two, so it doesn't happen again, or at least you understand the mechanics so that if it does happen again, you know how to think about the event. And for completeness, going down in value doesn't mean that a person has realized the loss. It simply means that the value of the investment today is less than at a point in the past. And the difference between a realized loss and an unrealized loss is simply whether someone sells the investment and crystallizes the loss, or they're just writing it out and the asset is going up and down in value, and in this case down. All right, let's get into it. But before we do, at the end of the video, I'm going to give you my prediction of where the 2023 cost of living adjustment will land. It comes out on the 13th. All right, let's go. Let's talk about the go-to move, and that is to blame the fund manager. This is the individual who gets paid to decide which investments to put your money into. When it comes to this point, by the way, I don't believe a fund manager gets a free pass simply because they're doing as well as their peers, and the whole lot together is doing quite badly. They're getting paid to manage the assets in the fund, and that amount is not insignificant. For example, the Fidelity Freedom 2020 Fund, 2025 Fund, and 2030 Fund have not insignificant fees. And all three of these funds are down at least 20%, and one as much as 21.54% year to date. And the Dow Jones Industrial Average, as of this morning when I gathered the data for this video, by the way, is down 19.38%. So each of these three funds underperformed the Dow Jones Industrial Average year to date. Now, to give some cover fire to Fidelity, the S&P 500 index is down 23, almost 24%. So the funds did outperform the S&P. Now, it's easy to pick on Fidelity because they're the biggest, or one of the biggest anyway, but let's look at Principal and Vanguard and see how they did. We'll look at the 2020 fund, so people that are already in retirement, their target year was 2020. The Fidelity fund was down 20.07% with an expense ratio of 0.58%. Principal was down 17.83% with an expense ratio of 0.56%. And Vanguard was down 17.73% and an expense ratio of 0.08%. Very low fees at Vanguard. Now, before you fire your fund manager, it's important to know what happened. Stocks and bonds are supposed to seesaw. That's what generally happens in the markets. When things are going well in the equity market, people are selling their fixed income investments and jumping into the equity market. When things start to turn the other way in the equity market, they're selling their equity and buying fixed income products, bonds, basically. So if you have a 50-50 mix of equity to bonds, when your equity is losing value, your bonds should be gaining value because people are bidding the value of those bonds up. They're buying more of them. And the more buyers there are, the more expensive the bonds become. But here's what happened. Let's say I'm a hedge fund manager and I put bets on the market for my clients. I have $1 million just to make the numbers nice and round. Generally, hedge fund managers have a lot more than this, but let's assume $1 million, and I have to allocate the $1 million to investments. When things are going well, I'm putting it all in equity, and let's say we put it all in an S&P 500 index fund. Let's say that things feel like they're starting to turn, It's January 2022, and the hedge fund manager looks over to Europe and he sees that some things are not right there. A smart hedge fund manager knows that the market isn't necessarily always driven by company performance, but sometimes there's an element of fear that drives buying and selling. As things start to go down, the more they go down, the more afraid people get. That causes more selling, and that causes more fear, and it becomes a self-fulfilling prophecy, even if the economics or the fundamentals of the company or companies has not changed. But the hedge fund manager is smart. He or she knows that it's coming, and they start to sell ahead of the crowd. In fact, they sell all $1 million of the S&P 500 index, and it's sitting in cash. So they have $1 million in cash, and they look across the markets and they see that Boeing is offering bonds, and those bonds pay a 2.5% yield. So the hedge fund manager takes that money and puts it in Boeing. 2.5% is better than nothing. They can always sell later, but right now they want some sort of return. But a problem starts to emerge, one that hasn't happened before. The 10-year government bond yield starts to move up very, very quickly. Now, a big move in the Treasury market might be 50 basis points, 0.5% over 6 or 8 months, 75 if it's a really big move. But the government is rapidly raising short-term interest rates, and this has a ripple effect out to 10, 20, even 30 years on the government bond curve. When the hedge fund manager bought Boeing, the 10-year government yield was 1.79%. Today, it's 3.89%, so it's 2.1% higher. So if a hedge fund manager wants to sell the Boeing bond, which pays a 2.5% coupon, and they're competing against a 3.89% government guaranteed Treasury bond, you have to sell that Boeing bond at a discount. That's just what they have to do. Otherwise, no one's going to buy it. So if I want to sell my 10-year Boeing bond and it's 1.39% less than the government bond, you multiply 1.39 times 10 years, and the very minimum that I could sell my Boeing bond for is 13.9% less than the amount that I purchased it for. The minimum. And that assumes that there's no risk difference between a Boeing bond and a government bond. Realistically, there is. So a more fair assessment is about a 2% per annum difference, because the government bond is government guaranteed. The Boeing bond is not. 2% per year times 10 years is 20%. So in order for me to sell my Boeing bond, I have to sell it for 20% less than what I paid for it back in January. This means if the hedge fund manager was to sell the Boeing bonds, $1 million worth of Boeing bonds, they would get back $1 million less 20%, or $800,000. If they sold, that would be a realized loss. They would have crystallized the loss. But if they hold on to it, it's just a asset revaluation on paper. How much are the Boeing bonds worth today? In this case, $800,000 instead of $1 million. Still, that number is important because you need to know what your portfolio value is, and you don't want to have to sell it to find the answer to that question. Now, age-based funds or target date funds often have a mix of about 50-50, particularly if you get close to or into retirement. 60-40 to 50-50 is not an unusual mix. Of course, Fidelity, with $68 billion worth of investments, doesn't just own 1 million Boeing bonds. They'll own Boeing, they'll own Microsoft, and they'll own half a dozen, 2 dozen, 3 dozen other companies, and they'll own them in very large quantities. But rising Treasury yields affect all of the bonds the same way. If they have a lower coupon that they're paying the investors and interest rates are going up, the lower coupon is locked in. It doesn't go up. That means that the bond values have to come down. So the bond side of their portfolio is down 15 to 20%. And we know that the equity side, the S&P 500 index or the Dow Jones Industrial Index, is down 20, 21, 22%. Both sides are coming down simultaneously, which means your age-based fund, which is a mix of equity and fixed income products, is going to go down in value. If government interest rates had stayed steady or went up and down as they normally do in the market rather than government-created movement, then you would have seen a selling of equity and a buying of bonds, and that would have supported and actually increased the value of the bonds because you have more buyers and sellers. That's what's supposed to happen, and that's what's happened in the past. But the third element is inflation. This is something we haven't faced into really for decades. But the government intervention to control inflation means that new bond yields are going to be higher. Government bond yields are going to be higher, corporate bond yields are going to be higher. And those bonds that are already outstanding have to go down in value to compete. However, in 2023, if you don't see rising interest rates like we did in 2022, or if things level off, you should see more stability, all things being equal, in your target date fund. October 13th, the government will announce the 2023 cost of living adjustment, and my next video will be all about this adjustment. My prediction, by the way, is that the cost of living adjustment will be between 8.4 and 8.8%, and if pressed, I'd call it at 8.6%. For what it's worth anyway. We'll see how my prediction fares out on the 13th, but if you have a prediction about the cost of living adjustment, put it in the comment section below, and let's see how well you do. Also, check out my video on 4 ways you can lose your Social Security benefits. This is one of my most popular videos. It has over 1 million views. This is Jeff Schmidt. Thanks for watching.